Hello everyone, my name is John, and the Invest and Chill team has brought to you today its first video on index funds. I'm going to be your host, and we'll cover exactly what is an index fund, what it does, and why it's superior to invest in it compared to a regular mutual fund. But before we begin, we just want to quickly remind you all to not forget to subscribe and click on the bell notifications tool so that way you can stay tuned for when future videos come out. With that out of the way, let's begin. An index fund is a type of mutual fund that is characterized by lower costs than the average mutual fund. It does not attempt to outperform such an index, but rather it seeks to track the performance of that index it follows. For example, the Vanguard 500 Index Fund Admiral shares, also known as ticker symbol VFIX, are shares that investors can buy into and essentially own a piece of the S&P 500, which is a leading stock market index in the United States that tracks the 500 largest companies by market capitalization. Using the chart provided by Vanguard on ticker VFIX, the average annual return on $10,000 invested in 2009 has been 13.18% annually. Looking at an index fund that tracks the shares of small cap stocks in general, ticker VSMAX, or the Vanguard Small Cap Index Fund Admiral shares, the average annual rate of return has been 13.07% since 2009, which is nearly identical to that of the S&P 500. Since the 2009 financial crisis, stocks have given greater rates of return due to the unprecedented nature and severity of that time period. Generally speaking, asset classes such as stocks, bonds, real estate, etc. will usually perform very well after periods of chaos due to their prices being excessively depressed during those periods of crisis. One of the primary features index funds are renowned for, and rightly so, are its low costs. By low costs, I mean expense ratios ranging from 0.05% to 0.20% in most index funds, and in the case of Fidelity, being as low as 0.00% for one of their funds, requiring no minimum investment and really showing the push for lower fees and better management. And speaking of management, the goal of managers of many mutual funds, such as leveraged funds which seek to amplify the returns of the market, inverse funds which seek to amplify the returns of the market but in reverse, or just plain regular active mutual funds which seek to beat a certain market index. In comparison, index funds only seek to mimic the performance of a certain index, and in doing so bring the lowest fees possible to investors. This is actually one of the reasons why index funds have lower fees. Because they are not constantly turning over assets, otherwise known as portfolio turnover, commissions and fees from the turnover of those assets don't rack up as quickly. And not to mention that when assets are sold, taxes are incurred. Don't sell assets that often, taxes aren't as huge of an expense as, say, in regular mutual funds. For an apples to apples comparison, let's compare two index funds from Vanguard to see why indexing may be the better option. Let's take the Vanguard US Growth Fund Investor Shares / Admiral Shares, which is an actively managed fund which seeks to perform, or outperform I should say, the performance of the Russell 1000 Growth Index. The Vanguard Russell 1000 Growth Index, on the other hand, is an index fund that seeks to track the performance of the Russell 1000 Growth Index. When you combine the management fee for ticker VONG of around 0.11% plus the 12B1 fee, which is a fee that I don't want to go over in this video, but is basically 0% for ticker VONG, the total fund expenses plus other expenses equaling to around 0.01% is around 0.12% annually. For ticker VWUSX, there are no loads or charges imposed on dividends from the fund or fund purchases or a purchase or redemption fee, but there is an account service fee of around $20 annually. As for management, 12B1 fees, and other expenses, those total around 0.42% annually. As costs for these funds accumulate over time, the total expenses for the Vanguard US Growth Fund Investor / Admiral shares can total up to $530 for the investor shares and up to $380 for the Admiral shares, over the course of 10 years. This is in stark contrast with the Russell 1000 Growth Index Fund shares only costing around $154 after 10 years. And finally, for the returns and performance. For the 10-year period ending December 31st, 2017, the after-dividend tax gain on VWUSX shares, those of the actively managed fund, was roughly 8.5% yearly, and after taxes plus sale of shares was roughly 7.4% annually. The S&P 500 returned roughly 8.5% annually in that period, while the Russell 1000 Growth Index returned roughly 10% per year in that period. In other words, it underperformed its target index by 2.6% annually. As for the VONG shares, the index fund shares, they would have returned roughly 9.30% annually after net expenses, taxes, etc. Note that I did have to control for time length since the Russell 1000 Growth Index Fund wasn't created or wasn't around in 2007, but was created in 2010. In conclusion, the returns are pretty unequal and it's clear which fund is superior over the other. However, do your own research and put your money in a place that is best for you. With that being said, everyone, thank you so much for watching this video. Also, don't forget to check out our Instagram page at invest_and_chill. And also don't forget to join our Discord server, which has a link in the description below, as well as on the channel banner art. See you later, and don't forget to invest and chill.